All right, let's get right into it. Imagine you've poured literally your blood, sweat, and tears into building a business. You navigated that brutal startup phase, you survived the lean years, and finally, your company hits it big. You're ready to cash out, pop the champagne, and move on to your next great adventure. I mean, it sounds like an absolute dream come true, right? But before you start celebrating, there's a massive, incredibly complex reality you're going to have to face first, and that is the United States tax code. So, the multi-million-dollar question is this. If your business booms and you want to cash out, exactly how much of that money is the IRS going to take? Because honestly, exiting a business isn't as simple as just handing over the keys and walking away. The IRS has constructed this absolute labyrinth of rules, hidden traps, and weird exceptions, all designed to ensure they get their cut. And if you don't know how to navigate this maze, well, you could easily end up handing over a huge portion of your hard-earned wealth. To guide us through this explainer, we're going to look at a super fascinating case study from our source material. It's a company called Color Comfort Sheets, LLC. This business is owned by 3 people, Nicole holding 30%, Sarah with 40%, and Greg with the remaining 30%. Now, they were down to their last 10 grand when suddenly, media mogul Olivia Winstead endorsed their product on national television. I mean, practically overnight, the business just exploded. They were completely flooded with orders, sitting on some really healthy profits. So Greg, who's our non-managing member here, decides, you know what? This is the absolute perfect time to cash out my 30% interest. But the big question is, how exactly should he do it?
Okay, so here's our roadmap for the explainer. 1. The partnership exit dilemma. 2. Selling a partnership interest. 3. Operating and liquidating distributions. 4. The impact of hot assets. And 5. Special basis adjustments.
Part 1. The Partnership Exit Dilemma. Navigating Subchapter K. Greg wants out for sure, but he's got to figure out how to actually leave without getting absolutely crushed by unexpected tax bills. The reason partnership taxes are so unbelievably complicated is basically because the IRS can't quite decide what a partnership actually is. There's this constant tug-of-war between 2 tax philosophies. First, you've got the entity approach. Now, this one is simple. It treats your partnership interest just like a share of corporate stock. You sell it and you recognize a capital gain or loss based on your outside basis. Easy, right? But then you have the aggregate approach. This philosophy views the partnership not as one single entity, but as a big collection of individual assets. So under this approach, selling your interest means you are actually selling your tiny slice of every single asset the partnership owns. We're talking the cash, the equipment, the inventory, the whole shebang. And the wild part? The tax code actually uses a really messy mashup of both approaches, mostly to prevent people from distorting their income to dodge taxes. Moving on to Part 2, selling a partnership interest, which is Greg's first option.
Okay, so Greg could simply sell his interest to an outside investor or just to his current partners, Nicole and Sarah. Now, if the tax code only used that simple entity approach we just talked about, it would just be a capital gain. Boom, done. But remember that tricky aggregate approach? The IRS uses it specifically to lay a massive trap for selling partners, and that trap is called hot assets. The IRS essentially created this concept to stop partners from magically converting what should be highly taxed ordinary income into lightly taxed capital gains. Hot assets include things like unrealized receivables, so think accounts receivable for a cash method business, or depreciation recapture. They also include inventory items. But here's the real kicker. When it comes to a sale, the IRS defines inventory incredibly broadly. It includes classic inventory, sure, but also literally any asset that isn't a capital asset or a Section 1231 business asset. So if your partnership has these hot assets, there is just no way to escape ordinary income rates on your share of them when you sell.
So if Greg goes ahead and sells his interest, he has to run this very strict 3-step calculation. Step 1, calculate his total gain or loss. He just subtracts his outside basis from whatever he's getting paid. Step 2, he has to look inside the partnership, identify his share of those hot assets we just went over, and calculate the ordinary gain as if the partnership sold them at fair market value. Finally, Step 3, he subtracts that ordinary hot asset gain from his total overall gain. Whatever is left over, and I mean absolutely only what is left over, gets that favorable capital gains treatment.
Part 3. Operating and liquidating distributions. The alternative exit.
Now, selling isn't Greg's only option here. What if the partnership just hands assets directly to him? Well, we need to clarify 2 different types of distributions. First, operating distributions. This happens when you take some profits out, but you actually stay in the partnership. You rarely recognize a gain or loss here. You just take a carryover basis in whatever assets they give you. But Greg wants out entirely, so he's looking at a liquidating distribution. This terminates his interest completely. The whole goal of the tax rules in this scenario is to take Greg's outside basis in his partnership interest and perfectly allocate it across whatever assets the partnership hands him on his way out the door.
And wait, before we look at the actual math, I have to remind you of a crucial and honestly often overlooked rule. In a partnership, your outside basis actually includes your share of the business's debt. So if you leave and the partnership takes over your share of those liabilities, the IRS treats that exactly as if they just handed you a giant stack of cash. Seriously, that debt relief directly reduces your outside basis, and if it somehow exceeds your basis, you are recognizing a taxable gain immediately, and that's even if no actual cash ever changed hands.
Part 4. The impact of hot assets. Let's look at Greg's high-stakes choice.
Okay, crunch time. It's time for Greg to choose his exit path. Let's consider his two options side by side. Option 1 is that liquidating distribution. Here, the partnership is going to hand Greg $242,000 in cash, plus his fair share of the accounts receivable and the inventory. Option 2 is a direct sale. Nicole and Sarah will just buy Greg's 30% interest outright for $374,000 in pure cash. Now, in both of these scenarios, he's relieved of his $66,000 share of the partnership debt. If you look at it economically, these look pretty much identical. But tax-wise, oh man, they are worlds apart.
And this right here brilliantly illustrates why tax planning is absolutely critical. Just think about the massive difference here. If Greg chooses option 2 and sells his interest, he gets hit with $106,000 of recognized gain immediately, right in that tax year. And because of those hot assets we calculated earlier, $60,000 of that is taxed at high ordinary income rates. Ouch. But consider option 1. Because he took a liquidating distribution that included his proportionate share of the hot assets, the tax rules actually allow him to defer all of that gain. He pays zero tax today. None. He only pays the tax later when he eventually sells that inventory and collects those receivables. So unsurprisingly, Greg goes with option 1 so he can keep his capital working for him right now.
But hey, quick reality check here. Greg only achieved that awesome tax deferral because he took his exact fair share of the hot assets. If Greg had tried to be sneaky and said, hey, keep the inventory, just give me $328,000 in pure cash, he would trigger what's called the disproportionate distribution rules. The IRS is going to look at that and view it as Greg secretly selling his share of the hot assets back to the partnership in exchange for cash. They'll force a deemed sale, and he'd get slammed with that ordinary income immediately anyway. You just cannot outsmart the IRS by simply leaving the hot assets behind.
Part 5. Special Basis Adjustments. Fixing the basis gap.
So, Greg is safely out, his taxes are deferred, and he's happy. But what happens to the partnership he just left behind? Well, ask yourself this. If a new buyer purchases a partnership interest for a high fair market value, their outside basis is going to be high. But the partnership's historical assets, what we call the inside basis, stays exactly the same. So when the partnership later sells those old assets, the new buyer gets allocated a share of that gain, even though they literally already paid full price for that appreciation when they bought their interest in the first place. They're essentially being double taxed temporarily. So how do we fix this really unfair gap between inside and outside basis?
Enter the Section 754 election. When the partnership makes this election, it essentially authorizes special basis adjustments. Think of it as a way to fix the glitch. If a partner sells an interest, Section 743B kicks in to adjust the inside basis of the assets just for that new purchasing partner. It steps it up so they aren't overtaxed. Now, if it's a distribution that causes the mismatch, Section 734B kicks in to adjust the common basis of the partnership's property for everyone remaining. And then, Section 755 steps in to dictate exactly how to allocate that adjustment across all the specific assets. It perfectly fixes the artificial income distortion. It's pretty brilliant, honestly.
Now, usually, Section 754 is an election, meaning you choose to do it. But the IRS isn't blind. They know partnerships would only ever make the election when it benefits them by stepping up the basis. So the IRS made these adjustments absolutely mandatory if there is a substantial built-in loss of more than $250,000. If the assets have lost significant value, the IRS forces the partnership to step down the basis. This prevents the new buyer from claiming an artificial loss they didn't actually suffer. But to really put this into perspective, let's look at how powerful this mechanic is for the ultra-wealthy. Think about billionaire sports team owners. When they buy a team, which, by the way, is usually structured as a partnership, the tangible assets, like equipment or whatever, are just a tiny, tiny fraction of the value. The real value is in intangibles, like goodwill, broadcasting rights, and player contracts. By using these exact positive special basis adjustments we just talked about, these owners can allocate almost their entire multi-billion-dollar purchase price straight to those intangibles. And since the tax code allows those intangibles to be amortized over 15 years, these billionaires effectively write off their entire massive investment against their income, avoiding just staggering amounts of taxes. It is literally the exact same Section 754 mechanic, just scaled up to the highest possible level.
Which leaves us with this final thought. We've navigated the maze of exiting a partnership. You've seen the trap of hot assets, the flexibility of liquidating distributions, and the immense, incredible power of special basis adjustments. But here's the thing. Tax planning doesn't start when you want to leave. It starts on day one. So I leave you with this question. You now know what the IRS maze looks like on the way out. But is your current business structured right now to maximize these exact same rules when it is finally your turn to cash out? Take a really hard look at your operating agreement, folks, because the day your business booms, you better believe the IRS will be waiting. Thanks for hanging out with me on this explainer, and keep learning.